Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management. It is June 17th, 2021. I did get the year right this week, but before we get into things, what we really wanted to do this week specifically, given that it is June 30th and the half year mark is going to be approaching, is to really review some of the factors that are driving some of the underperformance year to date. Unlike 2019 and 2020, where we experienced 41% and then 101% rates of growth last year, we're down about 8% this year. And, the market's up 10. And it's important to own that. It's important to discuss that. But more importantly, to go through the reasons why that has happened, and more specifically, why we think the path forward is even brighter now because of that. And so we're going to go through all of those points today. So I'm going to go ahead and share my screen here. And really, it's our presentation this week is titled Short versus Long-Term Performance. And flat out, we have underperformed this year. And despite that, we are more bullish than ever. And the three core reasons why we are more bullish than ever is because the Federal Reserve remains incredibly dovish. We saw over the last couple of days, the media interpret the Federal Reserve comments as hawkish when they said they were going to raise interest rates twice in 2023, not 2021, 2023. The last time we experienced 6% GDP growth with 5% unemployment, I got news, ladies and gentlemen. The Federal Reserve was hiking interest rates that day, not 2 years down the road. So the fact that we're printing money and we got 0% interest rates for the foreseeable future, that is incredibly accommodative, which means higher nominal growth and higher reflationary forces. Number two, oil and materials consumption continues to increase big time, and that is being fed by the emergence of a new infrastructure supercycle. We want to be long assets that are tied to that infrastructure supercycle. And last but certainly not least, consumers are flooded with cash. The average checking account has increased about 4 to 5 times versus pre-pandemic levels. A, that means that's good for the consumer, but B, that's really good for the banks because that's your raw material costs if you're a bank to manufacture more loans. And when you got 0% interest rates, your raw material costs are very, very low. And when your long-term interest rates are going up, well, then your pricing for your finished product is very, very high. And that means your margins are going up. So that's very good for the banks, and higher nominal growth means higher demand for loans. And again, good for volume of the issuance of new loans for those banks. So again, let's not get caught up with the day-to-day in the stock market. It's easy to do. I watch my account on a daily basis. It's what I do for a living, but let's be honest, I would do it anyway. And so, it's hard, but we should not really watch the market day to day. Now, in the very short term, why have we underperformed? Quite simply, we've been at the whims of a series of vicious internal rotations in the market this year. Almost 100% of our underperformance, ladies and gentlemen, can be tied to the months of February and March, when we were overweight technology, and technology began to top out on a generational basis. And we're going to go through why some of those valuations remain at nosebleed levels, despite the fact that we saw technology perform well over the last week. Number two is that we are very different than the index. So this exposes us to these quick rotations, right? So we were very overweight technology, and guess what? When that rotation hit, that hits us hard. Because we try to be different than the index when the fundamentals and the technicals align. Number three, after a 10-year bull market, that technology sector did begin to crack in February. Now, that's been our key play for the last 4 years. So dating back to 2016, and actually even since my last firm, going back the last decade, technology has been our key overweight call. And when those cracks started to appear in February, when valuations started to matter, it was important for us to rotate out of that sector. And when we start to rotate from one theme to another, we're going to suffer periods of underperformance. And the transitions are never perfectly clean. And that's the truth. And that's what most portfolio managers won't tell their clients. It's a messy process. You got to sell, you got to buy, and you're doing it during a very volatile environment. And so, A, the overweight position in technology, and two, the constant volatility that we've seen underneath the surface of the S&P 500 has been the prime reasons for that underperformance so far in 2021. And lastly, of course, over the very, very short term, over the last couple of days, obviously energy and financials have entered a period of consolidation. We're not bothered by this at all. I want to be very clear about that. My personal account, our family is 100% long oil and gas. We are very bullish on this. When we think of how we can double a client's assets over the next 5 years, this is the sector. And anyone will tell you that when it comes to my own personal account, I don't own an asset unless I think I can double that over 2 years. So that tells you what I personally think about oil and gas. Now, let me just go back one slide here. Now, what are the keys to performance going forward? Because that's what matters, right? For those who are invested today, whether you've been a long-term client and you're up 200%, or you're with us since the start of the year and down 8%, the key is what's going to happen going forward. Now, if you think the US dollar continues to fall relative to other major currencies, in other words, you believe the US dollar, based on fiscal spending, the government in power, and what their spending priorities are, if you think that's going to take the US dollar down relative to the euro, the Canadian dollar, the Chinese renminbi, then we're the right strategy for you, because our sectors benefit from falling US dollars. If you think oil prices will maintain or increase their current price levels because you're driving more than you did a year ago, in fact, you're driving a lot more than you did a year ago, then we're definitely the right strategy for you. We are 37% weight in energy versus 2.5% for the S&P 500. If you think long-term interest rates are going to increase because of fiscal spending in the US, in other words, debt holders requiring the US to pay more because of their fiscal situation, if you think long-term interest rates are going up because of the Federal Reserve or because of the overall economic recovery, we are the strategy that can outperform over the next 6 to 12 months and beyond. Why? Because we're overweight the banks. Third, if you think the Western world follows through on infrastructure spending and we are entering an infrastructure super cycle, then we are definitely the investment strategy for you, because we think that based on these factors at hand, plus a US and global GDP recovery, the assets that we own today are not only underloved, underowned, and undervalued. In fact, the only cheap sectors left in the S&P 500, we think those sectors are primed to lead the market, become new market leadership over the next 3 to 5 years. That's an important point, because in 2016, that's what we were looking for, and that's what we saw in technology. When we buy an asset, ladies and gentlemen, over the next 5 years, we want to see that asset double. Why? Because your average stock, in fact, the S&P 500 has about a 15 to 20% standard deviation. In other words, annualized volatility. So if the annualized volatility is about 15 to 20%, I want that asset to go up at least 20% a year. Now, we have a diversified portfolio. Not all of our stocks are going to go up 20% a year, which is why we have targeted growth rates that are lower than that. But when we buy a stock, if we don't think that it's going to go up 20% a year, in other words, 100% over 5 years, then why on earth are we buying it? We need to be compensated for volatility. We want volatility. That's a good thing to have. Second, we want to try and invest in assets that have volatility premiums. We're going to go through this concept in a bit, but volatility premiums lead to higher asset prices in the future when the fundamentals improve, buyers come back into the market, and risk premiums drop. That's important. If you buy assets when volatility is low, the likelihood is that volatility is going to increase and send asset prices lower. That's something you won't hear in the media. And then lastly, we always want to make sure that that 5-year double philosophy is keeping our short-term, is forcing us to be short-term disciplined, right? Because if you start to chase returns month to month, hey, you know what? Steel was up today. Let's buy some steel. Or technology is up tomorrow. Let's buy some technology. You'll never generate returns. You'll never generate outperformance. You have to be different than the index. You have to be invested in assets that are underloved and underowned, and those fundamentals have to be improving. That's how you generate the outperformance over time. And ultimately, what we need to see happen is for those underloved and underowned assets to become loved. And that's what happened with technology. They were underowned, they were unloved, and they eventually became owned and loved. And that's what generated those massive returns from 2016 to 2020 for the opportunity strategy. And that's what we see going forward. Now, valuations. It's so important, ladies and gentlemen, that when we think of over the next 3 to 5 years, how can we double our clients' money, right? And one way we have to do that is to make sure that there's room in the valuations to price those assets upward. When we look at technology valuations, I mean, a picture says 1,000 words. So yes, technology outperformed over the last week. So what? Do you want to buy technology with these sort of valuations right now? So when we look at the cyclically adjusted PE ratio for technology, we're at near all-time highs. I think the only other time period that exceeded it was the dot-com bubble. So go ahead, you can buy those assets, but we're not, because eventually I'm going to buy those off you at much lower prices. Meanwhile, energy valuations are near all-time lows. Yes, we did have lower points during COVID. Well, you strip out the impact of COVID, we're near all-time lows for energy. And guess what? We're using more oil, right? The valuations are rock bottom. Energy demand is going up, and there's no supply response. This is a prime mix for a long-term secular bull run in an underloved and underowned sector. And of course, no one loves it, right? We hear this rhetoric that no one uses oil anymore. Have you been at the gas pump lately? I think it's like, well, $4.50 a gallon here in California. Trust me, we are using a lot of oil, and we're going to use more of it as the economy continues to recover. Also, energy kills the planet, right? This whole green narrative has forced a lot of underinvestment in the sector, which guess what? When you underinvest in an oil well, in an oil field, it takes years to catch up. So it's not like a spigot. It's not like a water faucet. You can't just turn on the faucet and suddenly a bunch of water comes on. It's going to take years to catch up. And so between the years of 2021 and 2035, until we really have an alternative source of energy that we can replace oil with, there's going to be a huge supply shortfall. And we believe that's going to send oil prices above $100 a barrel. So we want to be long those assets that will benefit from such a scenario. So overall, why do we like energy? Massive, massive pickup in global energy consumption, a lack of supply response. We can't get the supply to meet the demand. And then of course, no one owns it. Everyone owns technology right now. No one owns energy. These transition periods take time, and sometimes you get sloppy days like today and some sloppy weeks like this week. But you got to see through that, because that's how you gain wealth. That's how you beat the market. And then of course, the performance. Ladies and gentlemen, the S&P 500 over the last decade is up close to 200%. Energy's down almost 2%. Think about that for a second. The S&P 500 is almost up 200% and energy's down 2%. The energy sector weight is down to close to 3%. Now, though, there's something different taking place. The fundamentals are improving. The technicals are improving. The cash flow generation is improving. Balance sheets are in a healthy state of repair, and no one owns it. I love that. Give that scenario to me 7 days a week, and I'll continue buying these stocks. So overall, that catalyst, higher employment, the Federal Reserve is going to continue to tolerate reflationary forces over the next 6 months, right? That's going to send nominal growth above Wall Street forecast. And that should overall feed the overall economic activity, oil consumption, bank loans, industrial activity. And that is the catalyst for more oil consumption and higher oil stock prices over the very short term. And we talked a little bit about this, but just real quick here, as we can see, production just can't keep up with supply, or supply just can't keep up with consumption right now. So this is important. We haven't had this type of deficit in years. And this is something that the market has not priced in yet. And Wall Street is slow to respond. Only one analyst has their price target for oil over $70. 18 analysts are under 70. We're trading at 70 today. So we're going to see a massive readjustment in terms of the way that analysts are modeling all those oil stocks, because when you're an analyst, you take your strategist oil price and you apply it to your earnings model. And when that happens and you have to go from $65 to $75, you got to take your price targets up. And when you take your price targets up, then the buy side goes in and buys those stocks. That's what's going to happen over the next 3 to 6 months. And of course, if that does happen, we see the OIH ETF. The last time we were at $70 or $80 oil, we were at around $600 a share. Right now, we're at $200. You tell me what's going to happen once people start to buy into this overall theme. So overall, if you think the federal government will continue to spend money and more of it, if you think the economy will continue to grow and benefit from the reopenings, if you think higher spending sends the US dollar lower and prices higher, and you think technology stocks are expensive, well then, ladies and gentlemen, we are the perfect strategy for you going forward. And we think we are well positioned for significant outperformance over the next 12 months, 24 months, and beyond. Thank you so much for all your time, for all the coaching that you provide us on a weekly basis in terms of how we can communicate more effectively with you. And of course, if you have any questions, please reach out to your advisor or feel free to contact us at 888-543-3776. Thank you again and have an absolutely fantastic weekend.